When learning about the backtesting results and the edge that this gentleman here, Don Fishback, had uncovered and had shown in some of his videos on YouTube, I decided to apply some of the same theory to stocks, to crypto, etc., and see if I can predict with some kind of edge that the expected move of a stock, for example, will be different to what it's priced in at. So this is a form of arbitrage. If you know that something is going to happen which is going to be different from what it's priced in at today, that for me is just another definition of arbitrage. There is a gap there that you can exploit to make profit, and that's what I want to show you in this video. This video is dedicated to a gentleman who wrote to me, who's one of the wizards at Crypto Wizards, and he said, Sean, I've noticed on the dashboard, you've got some tools here you've not spoken about. Do you have a video linking to these? And I didn't. In fact, I've kept all of this exceptionally quiet. It's been here for a while. I developed this out of my own interest when I discovered something. In fact, I was so excited when I discovered this. My son was walking past and he said, Dad, are you okay? And I said, yeah, I think I've broken the stock market. So this is really, really cool and interesting what I'm going to take you through. I think you're going to really enjoy this video. I just want to go back to an options chain very quickly, just for those who are not too option savvy, because this is really going to help cement in what we're trying to exploit. And so when I look at this options chain, again, this is just for the S&P 500, but this could be any stock. I'm looking at the expiration of July the 27th, 2020. Doesn't really matter. I could pick anything right now. Excuse me. So right now, the price of the SPY is 323. Now, the cool thing about options is because we know how markets move, we understand that they follow a distribution curve. We've learned about this in the last series that we did on how to predict markets. In fact, the very first video went into this in a lot of detail, a lot more detail than I'm going to go into here. But we know that there's a certain percentage chance that the stock will end up at a certain place, a certain price, which is different from where it is today. So for example, the price today is 323. If I want to know the percentage likelihood of the stock, or in this case, the SPY ETF, that it ends up at 327, I actually already know that. There's a 32% chance that it will end up at or above $327. This is already known. It's already priced in to the options prices. Now, what if I had some kind of inclination or some kind of knowledge through statistical backtesting, etc., whatever it is, through technical analysis, or a combination of the two, which I'm going to show you now. What if I had some kind of edge there where I knew that actually the percentage chance of this happening is really only 15%, or something very different based on historically what has happened with this ETF or with the market in general. So to go and investigate this, the first thing I did is I took a look at, through watching some other videos as well, I took a look at a price chart. And I never really look at moving averages. I never really find them that useful other than, is the price trending below its usual average or is it trending above? I don't really need to talk much about that. However, for this testing that I wanted to do here, this actually becomes very useful. Moving averages become critical, actually very important, because what I wanted to understand is, similar to Bollinger Bands, how much is this price moving away from itself and how fast is it doing that? And based on the direction of whether it's exponentially going up or exponentially going down, what is its expected move? Or how did it end up moving compared to what it was priced in at to move? Let me explain. So if we look at this period over here, we can see that the price is rocketing up here. So here's the price here. We can see that it's got a fair amount of distance between this and its most recent moving average, and there's another distance between that moving average and this moving average, and there's distance between that moving average and this moving average, meaning that the price is really moving quite far from itself, if that makes sense. It's almost like looking at the z-score, the standard deviation. It's really moving quite a lot. Something else I looked at was compression as well, which I'll get into, but let's just stick with this expansion at the moment, or what I call this explosion or this expansion. So we're going to stick with this scenario for now, but later in the video, I'm going to come back and talk about compression. So what I did is I looked at this scenario and said, okay, if I go back in time for, say, 500 stocks, and let's call it between 350 to 500, because some of those stocks you might not trade due to liquidity or whatever, or maybe the stock prices weren't available when I was back testing. but between 350 to 500 stocks. Going back in time since 2015 and looking at every time this scenario happens, what is the actual move versus what the implied expected move is? The expected move meaning based on the volatility and not the implied volatility, because I didn't have that data. I actually just calculated my own actual volatility. So there are some nuances in this research that I had to do, but nonetheless, it gave me an idea. Did the stock move in line with itself and its normal distribution, or did it not? When I say normal distribution, for those who haven't seen the previous videos, stocks, the returns of a stock, so the difference between prices or the price over price, typically follows a normal distribution curve. So most of the time, you'll have your average here where the stock doesn't move very much. Very seldomly, it'll move a lot either up or down. That's essentially what we're looking at. Now, the results of this were really interesting. So I'm going to take you over to a chart very quickly here, which is a chart of Bitcoin. And so what I did is I did a whole bunch of modeling. I put this in Excel. I called my friend John, who I think you might have seen on a video somewhere here in Crypto Wizards. And I said, John, there's this thing, it looks really exciting and I'm going to develop some tools around it. And I was getting very excited, and for good reason. When I looked at this, I noticed with the price of Bitcoin that, again, there were very seldom circumstances when something was either exploding downwards, like it is here with these green bars. You can see the price really plummeting, or exploding upwards, which you can see here with these red bars. And so what I did is I said, okay, let's look at all these points in time. Here I'm looking at Bitcoin, but we did this for stocks. So if I take a normal distribution and I plot that over the price here, within a 10-day time frame, within a 20-day time frame, within a 50-day time frame, did it land within, or did it land without or externally to its expected move? Or did it land within the normal distribution or outside of the normal distribution of this expected move? Now, the expected move, for anyone who's super data science savvy, again, I used an actual volatility calculation because that's all I had for that. And the results that came out were astonishing. I'm going to show those to you right now. So what I did is I plotted all these stocks. So the first day that this happened, so I take the minute something new popped up, the first day that this happened, we modeled in, where was the price 20 days from now, 30 days from now, 50 days from now, or 50 days from when this event happened. And where was that in relation to where it should have been based on the standard deviation, based on its expected move? And we did that for all these stocks here. And so essentially there were 431 events that took place. And for anyone who's wondering, you can go and download this. For any of you members out there at Crypto Wizards, this model is on the downloads page. You can go and grab that if you want to actually go through this and vet it yourself. But essentially what I'd done is just looked at what were the results. Was it a 1 or a 0? Was it within its that range, that normal distribution range, or was it not? And let me explain what that means here. So here I'm looking at if it exploded upwards. So all of these ups mean it exploded upwards, up, up, up. This was an upward explosion. And all these downs means it plummeted or exploded downwards. How often did it end up lower by 1 standard deviation? So let me explain what that means. Let's go back to a price chart to really help illustrate what I'm talking about here. So if I look at this price chart here and I say take the price here today, if I draw 1 standard deviation away from that price below, so here's the price now, here's 1 standard deviation above, here's 1 standard deviation below, how often did it land below? That's what that section there meant. So if we go back here to our model, that's what this section here means. If I go back again to the chart and just illustrate here, how often did it end up above? That is this area up here, which I'm going to show you again. So what statistical occurrences happened either below or above when this event took place? And obviously down here, I've got within. So how often did it stay within? Being within 1 standard deviation above or 1 standard deviation below. And this is where the magic is. So if I go back here, I notice something very, very interesting. So here's where it ends lower. So again, let's draw that up here. So if we've got our price here, and this is where it ends lower. So this is lower, this is higher, and this is within. So here's the lower part here. This is the L, this is the H, and this is the within. So how often did it end lower? How often did it end higher? And how often did it end within? So if I look at this right now, I can tell you something very interesting. If I look at the within, I can see that within a 10-day period from when this event happened, 39% of the time it landed within on a downwards explosion. Now, this is quite a lot to get your brain around, or it was for me. I mean, I was doing this analysis and getting confused myself, but I really want to break this down because it's actually very, very helpful. Let's say I want to know whether this stock will be within the expected move. So I look at within the 2 standard deviations. Now, for it to be within 2 standard deviations, meaning if I look at my bell curve, and this is just maths now, this is not speculation. If I look at my bell curve here and I take 1 standard deviation from the current price here and 1 standard deviation here, there's roughly a 68% probability that it should be within 2 standard deviations. And that's usually what the options price is going to be priced in at. It's going to be priced in at 68%. But I noticed it wasn't. That's not what actually happened. It ended up being within this range 39 or 40% of the time. And within a 50-day time frame, it was 46% of the time. However, this is the one that really struck me as very, very interesting. Meaning that if I take this number and deduct it from 68%, there's a 28% variance from what it's priced in at. So now you could say, okay, well, if it's not typically staying within 2 standard deviations, which is where it's priced in at, where was it going? And this is where things get really interesting. It was actually so if the price had exploded downwards, in other words, let's get rid of all this noise. If the price had done this, then 42% of the time, it was going to be in this range here, the higher than, 42% of the time. That's what this is saying. It's a downward move, and it ended up, within a 10-day period, it ended up 42.5% of the time, the stocks ended up in this region here. Now, bear in mind, a lot of this will have to do with the market. Was the market going up over that period, etc.? But the real interesting point for me is that it was not staying within its 2 standard deviations. Meaning that if I was to trade this, I could either trade a credit spread for every time this sort of thing happened, and I would be right more often than 50% of the time. That's what I'm assuming in this. And again, this is all beta. You need to take this with a pinch of salt. But that's what the stats are showing. Now, I wanted to take this a step further because this was great because this told me statistically on average what has happened. But what I became more interested in is how can I take advantage of this for particular stocks? How can I see this for each individual stock? What I decided to do, obviously getting carried away with this, was build an algorithm that every single day, and this is happening now, it's going through these stocks, 350 to 500 stocks per day, and it's looking for this event. So when this event gets triggered, it's looking for this event, and it's highlighting when that event happens. And that is what this options exponential here is doing. So if we look at this options exponential, and if you click on that, and I've already opened the window, so I'm just going to run through these for you. If I already look at that, I can see something here has happened with Amazon. I'm just picking the first one on the list. Now, there's only a historical count of this happening 3 times since, say, 2015. So it hasn't happened very often with Amazon. So there's not much historical data for me to base a decision off of. But if I click on stats, it'll actually open up this statistical set of boxes here for me, which really are just the web version of this. And so this is what this is showing me. It's saying, hey, this was an upwards explosion. And actually, if I filter on this, everything right now is up. Because the market, by the way, as we know right now, is just skyrocketing and has been skyrocketing upwards, generally speaking, probably due to all the money that's being pumped into the system. But that's for a different topic. Anyhow, the point is that I probably wouldn't trade this Amazon item over here because number one, for an exponential move upwards, I'm more interested in the downward explosions, because looking at my statistical analysis, that's actually what seems to be driving results that are different from what the options models are pricing in, i.e. the arbitrage. That's really what I'm looking for. But just to help you out so that when you do see a downward explosion, you can understand what to do here. And you might want to trade the upward explosions too. I can have a look at, say, Google. So I'm going to hit stats on Google, and now it's pulled Google stats. Now, interestingly enough, with Google, it's had 26 events, 6 of which have been downward explosions, and 20 have been upwards explosions. And so if I look at the upward explosions over here, it actually shows me something very, very interesting. It says, hey, only 35% of the time, and remember, 68% for the within is what should typically happen, 35% of the time has this stayed within those 2 standard deviations. And again, this is using actual volatility calculations, not the implied volatility. This is very, very far away with, only 7 times it stays within. So we've had, 26 events, 20 of which are up. So 20 up events, only 7 of those have stayed within that barrier. And so as you know, and as one of the wizards here, our crypto wizards on the channel commented, anytime you have an advantage above 50%, you should come out on top. Well, this is a lot more than 50%, i.e. if we were to trade these sort of opportunities that really we know based on the behavior of this particular stock lands in this particular range, we should have an edge. That's the theory here. So going back to Amazon again, one of the things you can pull up is Amazon's profile, which just gives you some interesting stats off the bat, nothing too cool, but also an options chain. So I'm going to take you through that really quickly, because actually the point of this I want to talk about as well is options compression. I'll do these other pages another time. But this will give me some stats. It'll just tell me, if I don't know what the stock is, it'll tell me what that stock is. It'll tell me what, for example, the short ratio is. So this is how many calls are people buying versus puts. You can think of that almost in terms of how bullish is the market versus bearish for this particular stock. It gives me the book value and et cetera, et cetera. It gives me a returns profile. And I can even click on this to get to the options chain. I can also get to the options chain just from clicking here on chain. So when I do that, I get the options chain. So if I look at all the items on options chains, and I've got all the options chains here, I can just cycle through them. I can just hit my down arrow and it will just cycle through the chains. Now, bear in mind, the market right now is closed in the US as I'm recording this. So we don't have a bid and ask. We don't have an implied volatility. And this probability in the money that I showed you at the start of the video is essentially what I've aimed to calculate here, but this needs implied volatility. So when you look at this within US hours, you will be able to see this approximation of probability in the money. It's all here on this options chain, which is really cool. I built this options chain really for me because I was getting really annoyed with the existing options chains out there that weren't with brokers. They weren't telling me the things that I needed. Anyway, if I just hide this options chain for now, and I show you what's down here, I have some very interesting stats here about Amazon. Number one, I can see, what is the volume that has been traded in terms of calls versus puts. And I can see that by each option expiration. So in the near term, we've had a lot more calls traded than puts. But if I look at the open interest, i.e. how many open contracts are there right now, we've actually got more put open contracts on Amazon for this very near term than in the long term. And in fact, here looking all the way till January, we've got slightly more puts than calls, but really Amazon is looking about even. Different stocks, you'll see some very crazy differences between calls and puts. This will actually tell you what's happening in the market. Are more people holding contracts that are bearish about a stock or bullish? And when I say people, a lot of this is going to be institutions as well. Here we have the volatility smile, which again, we don't have implied volatility really up at the moment, but this will tell you again what that looks like. Again, I'm looking to do videos on these things for those who don't understand what any of this means, etc. And this tells me the implied volatility by expiration. Again, the markets aren't open, so you don't look at this data right now. But that's essentially what the options chain will give you. So if you're looking at this during market hours, you will get a heck of a lot of cool data, which we pay for here at Crypto Wizards. So it's really, really useful. And our algorithms cycle through all this data to provide all this information in one page where you don't have to refresh the page. You can literally just cycle through the different options chains. So if I show you here, I can literally just cycle through these. It's very, very useful. Now let's talk about compression. So if we go back over here to this chart here now, and I can't remember what this is. It could be Ethereum. I can't actually remember what I tested this on. What I was interested in were these periods here where the moving averages, they essentially compress with the price, and they've been like that for like 30 days. And this is the occasion here as well. That's what I'm looking for, is have we had this compression for a good amount of time? And in fact, the algorithm that I ended up building was even more stringent than what you see on this chart, because what I wanted to know is, what is the likelihood that the price will be outside of the expected range here? Now, something very interesting happens when we look at the compression results. Same thing we looked at before for an explosion event or exponential event. Here, we're looking at a compression event. And 30% of the time, we can see between, if I'm looking at a 10-day time frame or 50-day time frame, about 30% of the time, it ends up above. So let's draw that out again. If we look at the compression, this is what's going on. It ended up being above the standard deviation, higher. So if we look at the higher number here, about 30% of the time, it ended up being in this range. Now, what would have been priced in would have been 15%. Because if within two standard deviations is 60%, or let's call it 68%, or let's call it 70%, then we would expect about a 15% on each side here, which you can see is pretty much what we hit on the lows. We pretty much hit what we would have expected based on what would have been priced in, but not here, not when it came to being higher, which I found quite interesting. So we didn't hit the 70% here either. We had a 13% advantage, whether you're looking at the 20-day, the 30-day, or the 50-day time frame, which is very interesting. We didn't hit that. We actually hit something different. So when we look at the actual web page for this, I can see some really interesting results coming up here. Now, the only thing I'd say with this algorithm is with compression, it's pretty difficult to calculate this exactly right, because it can happen and then it can trigger off of the algorithm because it diverges a little bit, but then it sinks back into the algorithm, so it shows as an event again. So this is just something you need to bear in mind. However, I thought that these statistics were fairly interesting. If anything, the options exponential I think is more reliable and interesting, but I still wanted to include this here in case you found it interesting for whatever you're trading in options, etc. So now I've got the stock profile for Costco. If I want to look at it, I can see the returns profile. What's quite interesting actually when I look at Costco is I can see that a lot more happens on the bearish side actually for Costco than has happened on the bullish side since 2015. It's quite interesting because you can see the skew on this, and actually if I move this out the way, it'll give you the skew and also something called the kurtosis. The kurtosis is basically how fat is the distribution curve. Is it very skinny or is it large, basically? So that's essentially what that's showing, etc. I've got the options chain here as well for Costco, etc. Now, something I wanted to mention as well is I get a lot of questions for workbooks on the channel, and even from some wizards who might be members, you might not have seen, but everything is here for downloading. Anything that people have found useful, I put here for downloading. All the machine learning code for building AI models, etc. And there's a lot of them that I've developed there, both for feeding in multiple features into those models, etc. Everything's here. It's all included for you. It's here. You can come and download it. And it's going to be the same thing. In fact, if I refresh this page, it should be up now. Yep, this is now also available. So the options, exponential, and compression model is also now available if you did need to download that or you wanted to look at that data yourself, etc. By all means, please critique it, have a look at it. But more than anything, I hope you get a lot of value from it. Now, one of the sites I wanted to recommend for learning about options is optionsplaybook.com/option strategies. This tells you all the different ways you can profit using options as well. So if you want to mold a pricing strategy to make money, if the price ends up, say, up here versus down here, you can technically mold that using options prices. Now, I don't recommend, and I don't recommend this for myself, so I wouldn't recommend it for anyone out there. I wouldn't recommend coming up with super clever, complex strategies. There are strategies like my friend who wrote to me, one of the wizards who's one of the members, there are very useful strategies like butterflies, and there are ways you can manage that position. You have iron condors, which are very popular. For me personally, I just like credit spreads, so debit spreads or credit spreads, because I'm paying less in terms of bid and ask spreads, etc. And it also means that I really need to have some kind of directional edge, which is the challenge that I'm looking for. The reason why I built all of this stuff is because I wanted it at my fingertips. And this is what this provides for me. So that's why I built this, because I want that directional edge. I want that edge to tell me, should it be up or down, or would it be within or without the expected move? And that's essentially what this does. Anyway, your feedback is always greatly appreciated. I hope you have a good day and talk soon.